30 minutes until the cash trade after the biggest NASDAQ drop since 2022. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, don't call it a comeback. Futures are fluctuating after a sell-off wipes out $1 trillion from the NASDAQ 100. Citi downgrades the U.S. stocks, citing a pause in American exceptionalism.
President Trump says he'll buy a Tesla to support Elon Musk after shares in the electric vehicle maker fell 15% yesterday, bringing total losses this year to 45% and erasing $826 billion in market cap since the peak in December.
And shares of Delta and American wavering right now, but to the downside after slashing their guidance. But then you take a look at JetBlue managing to buck the trend. We'll bring you the latest on the airline industry, all of that and more. Coming up, let's take a check of these markets. We were setting up for a turnaround Tuesday, but you can see that early momentum is fading. The S&P 500 now unchanged, but the color is red. Same story if you take a look at the NASDAQ 100. Small moves, but it's amazing to see this after what we saw on Monday. A big plunge in the S&P 500. As Matt said, the biggest one-day drawdown for the NASDAQ 100 since 2022. So clearly, this pain valve isn't letting up just yet. You take a look at the bond market. We saw that big bid materialize for the long end yesterday. But these levels, we've been hanging out around this place for a couple days now, maybe a week or so, Matt Miller. 4.22% on the 10-year Treasury yield. Feels like we finally maybe settled a little bit.
Talking about 420 there. I want to show you something absolutely fascinating that Dan Curtis, our producer in London, discovered. The only time that we've ever seen a drop of more than 2.5% on the S&P with fewer than 400 stocks falling has been the dot-com bubble other than yesterday. Take a look at this bubble here. This one next to it, this one next to it here, Joe. That was 12/20/2000. So 339 decliners, 3% drop. If you look over here, you'll see also 2001. If you look over here, you'll see 2000, here 2002. So the only time that you've ever seen fewer than 400 stocks drop and bring us down more than 2.5% was yesterday when we had a drop of 2.7% and 345 decliners. It's very eerily reminiscent of the tech bubble burst.
But kind of a silver lining, isn't it? In some ways.
In
what way? In that not everything was down on a catastrophic day.
Yes. There were still 155 stocks up.
Silver lining
there. You go.
Matt Miller. Now, some stocks we're watching, Tesla trying to stage a rebound, not doing so hot at it. It's roughly flat on the day. They were up more this morning. Remember, they had led losses in the Magnificent Seven. They've been doing that all year, and it's a much-needed boost because they recorded their worst day since 2020. We're keeping an eye on Delta Airlines this morning as well, down 2.7%. The airline is slashing its first quarter revenue guidance on weakening travel demand. A lot of investors getting a little more worried about the airlines given a weakening data, potentially weaker consumer data. Kohl's also down 16%. Similar reasons because they joined the growing list of retailers sounding the alarm. They've delivered a disappointing outlook. That cautious consumer taking a bite out of Kohl's right now, Matt. And remember, this is a stock that's already had a brutal couple years now.
Yeah, it's been very bad for a lot of these companies. I thought, Tesla's market cap wipeout since the peak, they have erased more in market cap than Ford, General Motors, Stellantis, Toyota, Volkswagen, Mercedes, BMW, Porsche, Ferrari, Renault, Nissan, Honda, Toyota, all of those companies put together.
Are you sure that's all?
All of those companies, Aston Martin, all of those companies put together in market cap still doesn't equal what Tesla has erased since December.
It has been stunning, and it's stunning because we heard from Dan Ives in a note last night saying that, of course, he's still bullish on Tesla. He still believes in the future, and he thinks that full self-driving will be a game changer. But he did say this has been a gut punch, I believe is the word that he used. For Tesla bulls, including himself, it's been really, really painful out there.
One thing I think is fascinating about this, you look at all the trades that have been erased since the election. We've been talking about it. The NASDAQ 100 below 20,000. The KBW Bank Index also has dropped below that election level bump that you saw. You also have a lot of interesting moves that did not drop below that level. Can you imagine Tesla lost all of its gains, but Bitcoin did not? I think that's a little bit fascinating, given that the exuberance here has still remained in some pockets. You wonder whether they'll lose their bump as well.
Yeah, Bitcoin coming close, though. Let's stick on Tesla, though, because that has been one of the stories of this market. Shares of Tesla really wavering this morning after posting their worst day in over 4 years yesterday. You have concerns about demand for the company's EVs, sending the stock plunging by 15% on Monday. Let's break it down with Garrett Nelson. He is CFRA senior equity analyst. He has a buy recommendation on Tesla with a $440 price target. Garrett, that's just one part of it, isn't it? Because you think about all of these concerns coming to bear that Elon Musk's involvement with the Trump administration has created a brand risk, a reputational risk for Tesla. And there was a line in your note that really made me sit up straighter. Let's read it right now. Quote, we think it might make sense for Tesla to elevate a member of senior management to take on additional responsibilities to keep Tesla on track with its near and intermediate term goals, as Musk's Doge commitment won't conclude until mid-2026, although we don't think this is likely to happen. So, Garrett, it's not your base case, but talk us through why you think this should happen.
Sure. I think as Elon Musk indicated in the interview yesterday afternoon, that he is committed to Doge, and that's more like a 18-month consulting gig that doesn't conclude until the middle of next year. And so if that's his plan to remain committed to his Doge responsibilities, we think it might make sense in the intermediate term, just given everything that Tesla has going on at such a critical point for the company, with the pending launch of full self-driving in the Texas market in June, and an expectation that the Department of Transportation is going to come out with a new federal framework for autonomous driving. It's such an important time in Tesla's history right now that, I think he's at the point where it's very overwhelming. And so we think Tesla has shown it has a very deep bench of talent. They've shown that over time, numerous investor events over the years. And so we think it might make sense to elevate a member of senior management to take on more of the day-to-day responsibilities and make sure Tesla is still on track. Because let's be honest, Elon Musk is spending the vast majority of his time in Washington, D.C. right now.
Hey, I'm interested in the full self-driving potential. My buddy Alex Roy actually set a full self-driving cannonball run record in December, 98.5% of the time. He was not driving the car from New York to Los Angeles. They made it there in, I think, 39 hours and change. Is that really, though, worth so much? I mean, couldn't Alex have done this in a Mercedes? Aren't there other companies that have this kind of technology?
In short, no, not to the extent that Tesla has advanced their full self-driving. Really, ever since incorporating AI and NVIDIA's hardware, NVIDIA's GPUs into their development a few years ago, it's been staggering the advancements that Tesla has made. And so we don't think they're being given enough credit by the market for these innovations, and I think you're going to see it on display. I think once consumers see the capabilities of full self-driving, it's pretty staggering. The cars come right out of the factory and they drive themselves to the loading dock at this point. So, and there have been, these innovations are very well documented. There's a number of YouTube videos out there that investors can look at, and just to track the improvements of full self-driving through version 12 and now on different versions of 13.
I love that. If only If only they would have a big diesel V8. Then it would be perfect.
Yeah, for those folks that still want to drive on diesel. Garrett, anyways, your price target here seems to be more than double what the stock is trading today. And with the sentiment out there in the market, plus any concerns about near-term catalysts, things potentially being a bigger problem in the near term before they turn around, what is the big catalyst you think that can send this stock flying back to where you think it goes?
Well, on the catalyst, I think it's the launch of full self-driving. Ever since the robo-taxi day last October, it became clear that the story is all about autonomous driving going forward. Recent years have been more about electric vehicle volume growth. Now, going forward, it's going to be more about autonomous driving and showing the market that they have a differentiated product that's much better than the competition. So you have the launch of full self-driving. That will be very closely watched as far as the capabilities and the adoption of robo-taxis in the Austin market. And then what really drove the post-election surge in the stock price was, of course, the Department of Transportation naming the adoption of a new federal framework for autonomous driving that's really going to supersede a lot of these state level regulations. So that's really what drove the run up in the first place following the election in early November. But I also think it's really important to provide some historical context on this sell-off in Tesla. Since the end of 2018, this is the 8th sell-off that's happening right now. From peak to trough of 40% or more. So volatility has proven to be the rule, not the exception. And I think it's really important for investors to understand that. And every single time on these sell-offs, it's been a lucrative buying opportunity.
Sounds like Bitcoin.
A little bit.
Sounds like a meme stock.
Yeah. Garrett, great to get some time with you. That is Garrett Nelson of CFRA. I just think it's an interesting point because when it comes to Tesla, there's always been an Elon Musk premium priced in, and you can see that kind of getting priced out right now. And listening to Garrett, it kind of sounds like what he's saying is Tesla needs a CEO.
It's funny. I think about what happened with the X debt. No one thought it would get back to par, yet you had people buy it and get a sweetener with XAI as well. So I don't know. If you make that comparison, maybe equity holders have something to hold on to.
I do think that's a slightly different point, though, because you think about Elon Musk. He has been this distracted CEO. It just feels like that narrative is so exacerbated right now.
Right. It's fascinating, and we should have Garrett back because he points out that Tesla has a deep bench as well, and no one's ever heard of anybody else that works for Tesla,
Time to give other people the spotlight.
Let's talk to Saira Malik, Chief Investment Officer and Head of Equities and Fixed Income at Nuveen, a very important voice, not just because she's so smart, but she leads a business with more than $1 trillion in assets under management. So, Saira, you saw a lot of action yesterday, huge drops in the stock market, and we're now down year to date. We're down lower than we were when Donald Trump came into office. Is Wall Street just no longer confident that Trump is going to stick a soft landing?
Well, there's three factors driving this volatility, and that's the impact of Doge, the tariff roller coaster, and the growth scare. So first, starting with Doge, about half of the payrolls created since 2019 have been government related. So people are concerned that the job cuts that we're seeing at the government level will drive down the employment markets. Turning to tariffs, that roller coaster is causing fears of reacceleration of inflation, and that leads to the growth scare that also tariffs are causing. And if you look at the S&P 500, it's off about 8+% from its all-time highs. If you look at history, the last two drawdowns were about 9% and 10% on the S&P 500 over the last couple of years. So the S&P does look oversold, but what we need for investors to not sell the rallies is for a catalyst. And we don't really have a clear catalyst at this point. What markets would like would be watered down tariffs, some signs of tax cuts, perhaps a ceasefire, or signs that the economy and the consumer are not pulling back. And we aren't seeing that yet, which is why I'm not surprised that after yesterday's significant decline, we're not seeing the markets look like they're about to rally on the open.
Yeah, it's interesting to see that because, I mean, for a while, pre-market, it did look like that. And I was thinking about this note that we got from Peter Scheer of Academy Securities yesterday. He said that actually right now, what he's worried about is a rip higher than more of a dip. Maybe that fear isn't as pronounced right now, but it does seem like we've seen a total re-rating of sentiment. You think about Citi downgrading U.S. stocks, HSBC doing the same thing yesterday, JPMorgan, RBC, all tempering their bullish calls, if you will. You could build a case that you just have everyone rushing to the other side of the boat right now, Saira.
I mean, I agree with you. We could see a snapback, but my concern is that investors will fade that rally because investors have nothing to really hang their hat onto in terms of fundamentals to be bullish about. Now, there are a few things coming up. NVIDIA, tech has been a very important reason for this drawdown. NVIDIA has their investor conference next week on March 17th. Good news out of that could be a positive for the markets. You know, tech as a sector is about 30% of the S&P benchmark. And ever since DeepSeek came out and fourth quarter tech earnings were not as exciting as investors hope, tech has been a big reason for the market's drawdown. So we need some stability in tech. Maybe we'll get that in a week from NVIDIA. Markets are expecting 3 rate cuts this year. We're in the 2 rate cut camp because we don't think a recession is imminent. So there are some positive catalysts on the horizon. But for today and for the very short term, unless something comes out around tax cuts or tariffs being pulled back, there's just nothing for the market to say, you know, what's going to prevent us from going into a recession. And remember, part of this recession issue could be a self-fulfilling prophecy. If the consumer continues to pull back and employment markets show increasing signs of weakness, we may get that recession that we're worried about.
Right. It's the first thing I thought of this morning. Are we going to talk ourselves into a recession? You know, one thing I wonder about, even though you see the market trying to find stable footing this morning, not doing the best job at it, but the VIX is still a pinch higher. At 28, it's interesting. You have not seen the VIX sustainably above 25 since August of last year. It hit above 25 in December, but it didn't stay there. Does this mean that investors have to buckle up for a significant amount of time longer? And how do you play that volatility?
Well, August, you mentioned August of last year. That was that 9% drawdown on the S&P 500, which is what I pointed to, is that we are close to that levels. But that is concerning that the VIX is not at elevated levels. Also, we are not seeing a broad sell-off on the markets. It's been somewhat tech focused. So I think that, you know, that tells you that even though the market looked like it was somewhat washed out yesterday and sentiment's very negative, we're not convinced that this is the bottom for the markets. I think interesting to talk about, though, is what's going on outside of the U.S. That's not been a huge topic of conversation over the past couple of years because the U.S. has been such a dominant market because of technology. You are seeing non-U.S. markets. They started the year outperforming U.S. markets. The growth issues outside of the U.S., there's stimulus potentially coming in Germany. We're seeing a bit of a tech revival over in Asia. So I think this could be a year when non-U.S. markets actually outperform the U.S. markets on a continuous basis if these issues in the U.S. continue.
Well, Saira, hold that thought because that's a big call. You're sticking with us. That is Saira Malik of Nuveen staying with us. But let's quickly check on futures. You can see that now we do have a little bit more movement to the downside on the S&P 500, down about 0.1%. Big tech, that was your big loser yesterday, about unchanged, but the color is still red. Your outperformer, at least for right now, is the small caps. The Russell 2000 up about 0.5% pre-market. Much more coming up next. This is Bloomberg.
This AI CapEx story is decelerating. Obviously, the DeepSeek story that came out earlier this year, and all of that is really what's weighed on the kind of U.S. Indices as much as, say, Doge, the immigration enforcement, and tariffs and the like. So look, the growth story has been deteriorating. Markets have quickly adjusted. We've been using 5,500 as the low end of our range for the first half. We're almost there.
That's Morgan Stanley's Mike Wilson speaking with Bloomberg Radio this morning. And we are back here with Saira Malik. She is Chief Investment Officer and Head of Equities and Fixed Income at Nuveen, looking around the world in privates and U.S. stocks as well, with more than $1 trillion under management here to be overseeing. You were talking when we left off last around the ability for stocks outside of the United States to be outperforming this year, something we haven't seen in a while. You look at the outperformance already this year, and I'm wondering how much room you think there is to run, particularly when you look at the Hang Seng Index outperforming all of it.
Well, one key difference between U.S. and non-U.S., if you start with Europe, is tech versus non-tech. So Europe tends to be more cyclical. So as U.S. tech suffers, that's one reason why Europe could continue to outperform. Particularly, we like European banks, UK banks like NatWest. We think financials are in a very strong position, liquid, promising net interest income. All of that could be reasons for banks to outperform. Going over to Asia, it is the tech story with DeepSeek and tech companies there showing that they can integrate AI into their technologies at a much cheaper price than what the U.S. has been spending on it. So I think those are two areas. Now, back in the U.S. for investors, there's trillions of cash still sitting on the sidelines. So I think there are a lot of people right now going, okay, the markets are down quite a bit. Is this my time to get in? And I think, you can look at some of these non-U.S. markets, and even in the U.S., if you stay higher quality and defensive, I think that's how investors can conservatively get back into the market. So a stock we like in the U.S. is NiSource. It's an Indiana-based utility. It's an AI center, data center build out, and we think they'll increase their customer loads because of that. And it's also part of a sector that we like very much, which is infrastructure, which tends to be economically resilient and tends to perform well even during market downturns. So in the U.S., I think you can stay more selective. And for those looking at technology, a company like Broadcom. Now, this is a company that's bucking the trend in the artificial intelligence sector. Their chips are more customized, which is a narrower, faster growing part of the market, and their non-AI business is doing well. So there are areas that investors can look at who are sitting in cash and saying, okay, I want to start to leg back into this market because I do have a long-term view, and I think we're getting to a good price point to come back in.
What happens if the dollar continues to weaken, Sarah? I mean, you talk about the trillions in cash, and I look at money market funds, and it is shocking how big it's getting. But where is that coming from, and how does the math change if the dollar starts to fall?
I think that is a reasonable assumption to assume at this point that being more of a bear on the dollar could make sense. And that would be good for U.S. multinationals. That is good for U.S. large cap stocks, which has suffered under a stronger dollar regime. I think also looking at the 10-year, which has been declining now, getting closer to 4%, that's another tailwind for the markets and also a reason for investors to keep moving their money out of cash. The returns on cash is likely going to continue to deteriorate, whether the Fed cuts rates 2 or 3 times this year. So that is the time for investors to say, okay, maybe it is time for me to start slowly, dollar cost averaging in, waiting for that catalyst, because we have seen a very significant movement in the markets in a short period of time. So when that catalyst comes, I think the markets will rebound quickly. Now, as I've stated earlier in our conversation, though, I don't think that is happening imminently in the sense that I don't see that catalyst out there, but it could come anytime, just a change in tone from the administration around tariffs, some kind of tax cuts to come in to help the consumer, or a ceasefire with one of the 2 unfortunate wars still going on around the world.
So I want to meditate on cash a little bit longer and talk about where it's coming from, because I also look at the money market chart a lot. We're close to $7 trillion. Hopefully we'll show it. But a lot of those trillions came in after what we saw with SVB back in March 2023, I believe it was. So you could make the case that that's not necessarily money coming out of the stock market. It's folks coming out of the banking system and bringing their deposits to money market funds. And if that's the case, if that's where it's coming from, why would it leave if you're earning 4%? Because you're probably not getting much in your bank account.
I think it leaves because investors are going to see that 4% could continue to deteriorate over time as rates normalize. I agree with you that money didn't necessarily come out of the stock market, but this is also where one of the reasons we're very positive on fixed income, because we think that people will say, okay, I can earn 4% risk-free, but can I, for a low level of risk, incrementally out-earn that? And the yields that we're seeing on fixed income are much stronger. Again, it's not a duration bet for us. It's more of a credit call. We like higher quality areas of fixed income like senior loans and municipal bonds, where the states still remain in very good shape because of the tax revenues that they've collected. But that's an area also where investors can incrementally out-earn their cash for a reasonable level of risk. And I think that's what people are looking for. Given the level of inflation and that it's reasonably sticky, is 3-4% return on your cash going to be enough to out-earn inflation consistently? I would answer not by much.
All right, Sarah, great to get some time with you. That is Sarah Malik of Nuveen. Let's take a check on markets right now. In the pre-market, we are minutes away from the opening bell. The S&P 500 has been wavering back and forth. Hopefully we'll get it up here. You can see now down about 0.2%. The NASDAQ 100, it was fighting to go green. Can't say the same right now. Down about 0.2%, which is just stunning when you think about this index, down 3.8% yesterday. Just a total wipeout, the worst day for your big tech index since 2022, and it looks like that selling pressure is going to continue today. Small caps is your outperformer, but we'll see if that bid can hold all the way through 4 p.m. Coming up, it's the opening bell. We'll bring you all the action with Abby Yoder of JPMorgan Private Bank. That's up next. This is Bloomberg.
All right, we are moments away from the start of trading after a massive drop for stocks yesterday, something we haven't seen since the dot-com bubble burst. Such a big drop with so few stocks falling. Only 345 fell, and we were down 2.7%. Today, we're looking at futures that are off as well. We thought we'd see a little bit of a dead cat bounce, maybe some dip buying, but it hasn't really shown true yet. Right now, 0.2% down on S&P, NASDAQ down 0.1%. You've got Trico Bank shares. Apparently, they're celebrating a 50-year anniversary, and I looked at the shares. I just do a 5-year by default, a 5-year look. They're up like 60% with reinvested dividends, but I've started to notice the COVID effect is going to be coming into your charts if you do a 5-year look like I do, because you know, we're right there 5 years from the start of COVID. Capital Group ringing the bell down at the New York Stock Exchange. Let's go over to Katie Greifeld right now and see what's happening in the live cash trade now. Although, Katie, we know that throughout the day this can change depending on which members of Trump's cabinet go on Fox.
Yeah, it could be a wild one. To your point on 5-year charts, you just got to put your hand over the very start, and then things look better. But time will fix that. Time will maybe fix this market too, because it's ugly again today. Not as ugly as yesterday, where we were at 4 p.m., but you can see that that selling momentum is continuing right now to a lesser degree, but still the S&P 500 off by about 0.2% just in the first minute of trading. Keep your eye, though, on big tech. This index was down 3.8% on Monday. I can't say that enough, because it was the worst one-day drop since 2022, and today down another 0.1% or so. We'll keep our eyes on that one. Same thing too with the small caps, another thing to watch, because the small caps outperforming right now. They did get caught up with the selling pressure yesterday. They didn't fall as much as big tech, and the Russell 2000, at least for right now, for this specific moment, up 0.3%. Meanwhile, stocks to watch under the hood. Tesla trying to shake off yesterday's 15% plunge on demand concerns. We're showing some other big tech stocks here as well, but Tesla up about 1.4% right now. We heard from a bull at the start of the show saying that there's a deep bench and there's a lot of things to look forward to, Sonali, but boy, it has been an ugly 2025 for Tesla bulls. And, you know, interestingly enough, also kind of an ugly 2025 for the airlines as well. We're keeping an eye on Delta and American this morning. They're issuing warnings that consumer spending has pulled back sharply. Delta down more than 5% at the market open. American down more than 1%. But, Matt, this is a stock now down more than 28% on the year.
I'm just looking, I'm not sure, but Joe sent me a note that, yeah, Southwest Airlines is up 12%. If you check out shares of Love, they're doing the opposite of the other airlines right now. And well, we used to call it Southworst. Yeah, well, aren't they? They're ditching free checked bags. So they're theoretically going to make more money, but that's not a great experience for travelers. No, it's not, because then everybody brings the bag into the cabin. Yes. You know, yes. And that's a problem. That's how you get in fistfights. I'm watching Dick's as well as Kohl's. Both Dick's and Kohl's are lower right now, delivering disappointing results. The turnaround plan for Kohl's struggling to gain traction after 3 years of declining sales, and just generally, this gives us another view on the consumers. So, with Sonali's Airlines and these, I guess, retail stores here, the consumer doesn't look great. And then tech also looks pretty bad, with the Magnificent Seven stocks taking a big dive. Sonali's been noting all but Meta have fallen year to date, and even Meta's only up like 2%, or it was at yesterday's close. I don't know what Meta's stock is doing right now, but still someone about will probably the same, 2%, still 2.4%. Okay, still up 2% year to date. But here's the. It's a little confusing to look at this chart, isn't it? Yeah.
I love it.
How much value that adds.
Anyway, the Magnificent Seven is in a correction. It looks like it's down a little bit today.
Yes, that's a good point.
Yeah,
to
15%
mention.
on the year altogether.
Let's bring in Mandeep Singh to talk about this from Bloomberg Intelligence, where he's the senior tech analyst. And Mandeep, I was listening to Mike Wilson on Nathan Hager's radio show this morning on Bloomberg Radio, and he was saying the CapEx story is decelerating. Do you see that as well?
Well, when you look at these Mag 7 companies, they have grown at an aggregate, the top line, mid 20% in the past 6 quarters. Now, if you look at their CapEx guide, they continue to be quite optimistic about the Gen AI investment. So what the market is saying is, look, there is a lot of fuzziness around the impact of tariffs, especially for companies like Tesla that has a high China exposure in terms of sales as well as the cost side. And that's where I feel Tesla, Apple, to an extent NVIDIA, they are more exposed than the rest of the Mag 7, which don't have as much exposure to, tariffs or China sales. But those are the 2 variables I think that are in play. And then you layer in, just the speculation and the uncertainty around interest rates and other variables. But I would attribute the kind of the pessimism around fundamentals tied to the tariffs and China sales.
Mandeep, what about a recession? When you have more people out there worrying about the potential for a recession as well as a weakening consumer, how does that fall over into big tech? There was a time when they were considered somewhat immune.
Yeah, and that's what I said, 6 quarters. I mean, we just talked about Mag 7 because of that mid 25% aggregate growth compared to the 493 other companies in S&P 500 that really didn't have earnings growth. So if you are hit with a recession, it's going to impact the likes of Alphabet and Meta because of the digital ad exposure they have. And look, these are cyclical industries. So that's where the recurring business models, the software ones, I think will be the most insulated from a slowdown. And, if you are exposed to hardware, CapEx, digital ads, I think there will be more exposure to the recession element.
All right, Mandeep, great to get your insight as we watch this sell-off just deepen. That is Mandeep Singh of Bloomberg Intelligence. And let's keep the conversation going now with Abby Yoder. She is JPMorgan Private Bank U.S. Equity Strategist. Great to see you in studio.
Good to see you.
So let's talk about where we are. You take a look at the S&P 500. We're below 5,600. Mike Wilson sent a note yesterday. We could get to 5,500. We were just talking to Saira Malik, who said that she doesn't think we're at the bottom. Where do you think we are in this sell-off?
Well, yeah, I mean, this might not be the bottom, but we think we're, closer to the end of this sell-off than we are in the beginning. I mean, we're down 8.5% since the highs. I mean, you guys have been talking about all the data really. That kind of masks the carnage that's happening underneath the surface, right, with the Mag 7 being in correction territory and sentiment just being really bottomed out in terms of if you're looking at the AAII bearishness survey. So there's a lot going on that makes us feel like a lot of this has been flushed out from an index level.
How much of this is due to a growth scare or the expectation that these policies that are being put in place and sometimes taken out and then put back in and taken out and put back in are really frustrating businesses and consumers and going to lead to, if not a recession, at least a serious slowdown in growth?
Well, I think that's primarily what is happening, right? We've seen, and how that's being reflected in markets is through valuations, right? We went from 22.5 times, we're now around like 20.5 times for the overall index. Our view coming into the year was that we were going to see that multiple compression. We were calling for around 21 times, so we're actually calling for a little bit of expansion from where we are today. But this is really sentiment driven, and this is where we're rooted when we're thinking about re-underwriting our 6,400 for the year end, is are we seeing anything from a fundamental standpoint, both on the economic and the equity market perspective, that makes us want to reevaluate? And right now it's in the soft data, right? Like we're seeing that on the econ side. Today we got the NFIB, business sentiment that came down from where it was, right? That was what everyone was pointing to. And so that's a big change.
I want to follow up on just that point. I was watching that data. Feels like a year ago. It was just a couple hours ago. But the share of firms that raised prices increased the most since 2021, April of 2021. We have CPI tomorrow. A lot of investors now starting to worry about a potentially stagflationary impulse under the market. What are you more worried about, growth, stagflation, or inflation?
I would say we're more concerned about growth. Like that will be where stagflation doesn't really feel like the most likely scenario to us, just because we think the economic and labor market implications of what would happen if we saw an increase in prices would outweigh the inflationary impacts. So that's where our main concern would really be on the growth side, because that's really what comes through and hits fundamentals from a company standpoint as well.
So let's talk about what you like right now. I'm taking a look at your notes. You're recommending financials, tech, utilities, industrials. Financials and tech not having a great 2025. So what are some of the factors that are helping you keep the conviction right now?
Well, I think, obviously in January, there were a lot of concerns around what was happening with AI as it relates to, the tech infrastructure in the U.S. relative to the rest of the world, and in particular China. I mean, that kind of has taken a backseat in terms of now the focus is the policy uncertainty. But, the issue coming into the year was that expectations were really, really high, and they were mostly met during earnings season for the tech companies. It's just that, again, it's all about expectations, and if we're going to have beats and raises of billions of dollars throughout the cadence of 2024, and that changes and is a little bit smaller at the margin in 2025, that's where you see confidence a little bit wane a little bit. But for us, when we look at growth expectations for tech, 18% year over year, we're pretty comfortable with that. And similarly with financials, I think, this is policy uncertainty related as well, just what's happening with deal flow. You're seeing that kind of pushed out from 1Q, but we do see that coming through, and other fundamentals within financials looks great.
What do you think about overseas, or the idea that American exceptionalism, it's too dramatic to say the end of American exceptionalism.
I would agree with that, yes.
But Sonali has been pointing out a fantastic chart today. If you just look at year-to-date performance of the U.S. versus Europe and Asia, especially Hong Kong, and then the City call today, basically sell America and buy China. It's been a reversal of what I would have expected coming into Trump 2.0.
Well, I think consensus, that's contrary to what most of consensus was, too. I think if you're going to
Here's the chart, by the way.
If you're going to make the call to, rotate proceeds from the U.S. to the rest of the world right now on a tactical basis, you're betting on valuations for the most part, right? Because that's what we've seen. We've seen a re-rating in European equities from 13 to 15 times. Similar story in terms of China, and a de-rating in the U.S., right? So you're calling for, we believe in these fundamentals coming through. Right now, I think it's just the risk reward.
For the most part. But I will say, and I heard Trump say again that he loved Ronald Reagan, but he wants to do everything the opposite of what Reagan did, right? Europe is going to spend at least, $1.3 trillion, maybe more, on infrastructure and defense.
If they can get it through.
If they can get it through. True, the Greens could be problematic, as usual. But if they can do that, isn't there a fundamental case for investing in those companies?
Absolutely. Yeah. Longer term, again, if they can get it done. And look, we're not making the case that you should not have exposure to European and Chinese assets. Obviously, international diversification is always a prudent approach in portfolios. What we're talking about right now and tactically, you're really, from a valuation perspective, it's just not that compelling.
Abby, we thank you for joining us here on set. Of course, that is Abby Yoder of JPMorgan Private Bank, finding some sense in these crazy markets. Still crazy today.
I hope they turn around, though. Because my 401k, I'm looking at my retirement, and I'm thinking, how many more decades do I have to work?
Your retirement account. I cannot say that enough. Set it and forget it.
You need to find a new target date in 2070.
Right. We need to find a new squirrel for him to chase.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, in our 70s, and
I'll take care of you, Matt. Anyways, coming up, we're going to talk about those airlines as we've been talking about. American and Delta Airlines, they're both issuing softer outlooks thanks to weaker leisure travel demand. We're going to take a look at the sector next. This is Bloomberg.
This is Bloomberg Open Interest. A quick check on stocks. You can see the S&P 500 still feeling it right now, but we have a turnaround underway in the NASDAQ 100 with the big tech index up 0.3% following yesterday's wipeout. And the Russell 2000 still your leader, at least in today's action. The Russell 2000 up about 0.5%, but A lot can change between now and 4 p.m. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Amazon getting upgraded to a strong buy over at CFRA. The firm says that the recent pullback is a buying opportunity. Next up, we have Madison Square Garden Entertainment getting upgraded to a buy over at Wolfe Research. The firm says that its growth potential and, quote, permanent winner status are deeply undervalued. Finally, we have Capital One getting raised to a buy over at Baird. The firm also says that this is a buying opportunity. Matt Miller.
All right, Delta and American Air are issuing stark warnings for the U.S. economy as those carriers slash their outlooks in the face of weakening travel demand. Delta CEO Ed Bastian calling the first quarter, quote, a parade of horribles. Ouch. The announcements come as the companies present at JPMorgan's Industrials Conference. Here with more insight is Brooke Sutherland. Brooke is our Boston bureau chief. She also covers the industrials for us. And is this about a recession? Is this about a growth scare for the airlines?
I mean, I think what's interesting about this is that we've been hearing warning signs about the consumer from other parts of that side of the economy. If you look at comments from Walmart, from Target, from McDonald's. But what's been interesting is that travel demand has really held up quite well. Even as we've had all these various different scares about consumer spending, you've seen individuals keep going out and spending on leisure travel. So to see that pullback, I do think is concerning. Now, time will tell whether this is just a bit of a pause, given all of the uncertainty out there, or if it's more of a prolonged period of weakness. Keep in mind that the first quarter in general is not a big one for airline travel. So what you're really looking for is what happens over spring break. Do you see people taking the trips as they normally would? Do people continue to travel over the summer? Do they keep taking those transatlantic trips that have really been a moneymaker for the airlines over the past couple of years? But I will say what's also concerning to me is to hear the airlines talk about not just a dip in consumer travel, but also the corporate side of things, that uncertainty is really sort of leaking into businesses' willingness to spend on travel. Airlines were looking for corporates to really kind of sustain the recovery here, because remember that leisure really led us coming out of the pandemic, and the growth was really meant to come from corporates. And so to see a pullback there, I do think does raise some questions.
I'm going to take a question out of the Vibe session playbook here, because you mentioned spring break. I had already been planning my trips out into the next couple of months. It feels expensive, Brooke. And if you're feeling like it costs a lot to travel now, then how might you feel in a month from now? When you look at the Delta guidance here, they say that in the current quarter, earnings will be 30 to 50 cents a share compared with $1 of an earlier forecast. So the extent of the drop is already quite meaningful. So how does that translate when you see that kind of drop off now into what it might feel like later?
I think it's important to remember that there's also a bit of a perfect storm facing the airlines. So you do have, this consumer pullback, this corporate travel pullback like we've been talking about. You've also had the spate of safety incidents that I do think is impacting air travel to some extent. Now, the extent to which that extends, again, remains to be seen, or if it's just sort of a momentary question mark in people's minds about their willingness to get on a plane. So what's been interesting on the inflation front is that you really haven't seen the same degree of inflation in airline ticket prices as you have seen in other parts of the economy. And that's part of the reason why this had remained, a strong source of spending for the airlines. But I do think, to your point, as inflation starts to bite elsewhere, people might think twice about those airline tickets. It's sort of the ultimate of discretionary spending. And so if you do see people pulling back, that's a rather obvious bucket in which to do that.
All right, Brooke, great to get some of your insight. That is Bloomberg's Brooke Sutherland. And we do have to mention Southwest Airlines, one of your biggest gainers on a percent basis right now, currently up 8%. At one point was up the most since November 2020. So huge gains that we're talking about. Of course, Southwest ditching its free checked bag policies. Also, it cut its revenue forecast along with its peers, but it's accelerating its buyback. You add it all together, and it is a big day for Southwest, up 7.5%. Now, coming up, traders run for cover after Wall Street's latest market meltdown. That's next in our Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street beat, because from ditching U.S. stocks for Chinese rivals to buying the yen and the euro, strategists, money managers, they're all rewriting their playbooks, shifting towards safer options to escape the market turbulence. Bloomberg's Justina Lee joins us now. What's a good hedge in this market? What do you see traders flocking to, and how safe are those hedges, given that some of the trades that people are piling into a year ago would have looked crazy?
Yeah, I think what's been really interesting about this market sell-off is it's very U.S. specific, right? It's a complete reversal of American exceptionalism. Because if you look at what's kind of relatively doing better, it's like Chinese tech stocks and even the Chinese yuan, you know, the Swedish krona. So it's not, doesn't seem to be like a classic flight to quality play where everyone kind of goes to buy the dollar and long end treasuries. It's about specifically unwinding those high momentum trades that have been working and suddenly are not kind of for the past year. And so I think you raised a great question, because, you know, not too long ago, people were saying, you know, these Chinese stocks are uninvestable. But I think it just kind of shows that people kind of want to move money to kind of assets that are, you know, way cheaper right now and maybe kind of haven't benefited as much from those momentum plays over the past year.
Yeah, and to your point, Citi out with a head scratcher today, sort of downgrading the U.S. to neutral and saying buy China. But I want to talk a little bit specifically about the U.S. equity market. It was interesting to me that if you take a look at SPY, it's the S&P 500 ETF that's the largest right now. You take a look at volume, it was pretty contained yesterday, Justina. It seems like all in all, the narrative has been that this has been a pretty orderly sell-off so far.
Yeah, and I think, you know, we've definitely seen some, you know, hedge fund degrossing exposure. But if you kind of look at the broader picture, you're right in that there hasn't really been, you know, any intense panic, you know, not even kind of what we saw maybe in the August of last year or in the Volmageddon. And I think there are kind of two ways to look at this, right? One is that people are not panicking just yet because maybe they're not sure that we're really headed to a full-blown recession. But the other way to look at it, and I think that's sort of the question on a lot of people's minds today, is if a recession is coming, then that unwind is definitely not over. I mean, if you compare this episode to past momentum unwinds or kind of the short volatility exposures that are still out there, then we probably have, you know, kind of quite a way to go.
All right, fantastic intel, Justina. Thanks so much for joining us. Justina Lee, there out of London. You can check out her work on the terminal at Bloomberg.com. Coming up in the next hour, we're going to speak with the biggest bull on the street. John Stoltzfus joins us, Oppenheimer Asset Management Chief Investment Strategist. He has a 7,100 target on the S&P. This is Bloomberg. We are 30 minutes into this trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Let's take a check on markets right now. 10 seconds away from some breaking JOLTS data, but you can see the S&P 500 still lower, but that rebound in the NASDAQ 100 building steam right now up about 0.3% on your NASDAQ 100. And then you take a look at bonds selling off a little bit. And here comes JOLTS. This is for January. The expectation was for 7.6 million. We are coming in a little bit hotter than that, or above that rather, coming in at 7.74 million. Let's get right over to Bloomberg's Mike McKee standing by. How much can we actually glean from this, Mike McKee, given that this is data for January?
Yeah, I think you make an important point, Katie, because this was before all the Doge stuff started. It's hard to tell exactly how that's going to affect the overall economy. We did see some strength in February hiring, so does it matter? Not like it used to, but 7,740,000 job openings, significantly more than the 7,508,000 revised number from December. And the quits rate is kind of what a lot of people are paying attention to, goes up to 2.1%. So people felt a little bit better about getting a new job if they quit their previous one in the month of January. But it doesn't tell us a whole lot about where we are in the middle of March.
Yeah, or they were quitting ahead of the Doge. I mean, you say we don't know how that's going to affect the economy, but if you're firing 1 or 200,000 employees and cutting government spending, which is basically what Scott Bessent has told us was behind the expansion under Biden. Isn't that bad for the economy, at least in the short term?
Oh, sure. That just doesn't show up in these JOLTS numbers. I don't think we're going to get increased job openings since they seem to be eliminating jobs in Washington and other federal offices. But we are seeing some strength in hiring that basically makes up for the number of people who come into the labor force. We're not seeing a lot of growth at this point. And anecdotally, we keep getting told that companies are not really firing people, but just not hiring. It's the federal government that's firing at this point.
Look at these headlines.
Right,
Yeah.
we need to read some headlines as well because you have Trump on Truth Social talking about an extra tariff, an extra 50% tariff on Canada, aluminum, and steel. This is an additional tariff, he says. He calls it a 25% tariff on electricity coming into the United States. So clearly the turmoil still hitting markets.
Going into effect tomorrow, I think that's important as well. And you can see the S&P 500 now down close to session lows, so sort of losing that steam that it was building. The NASDAQ 100 hit session highs in the aftermath of that JOLTS data, actually, but now losing that momentum as well, up about 0.2% or so. So these hits just keep coming.
Yeah, and this is, I mean, so you've already got from Canada, at least from Ottawa, an export tax on electricity of 25%. And we're going to put additional tariffs, it looks like, on that electricity. By the way, Canadian electricity was much cheaper than U.S. electricity. That's why Canadian aluminum was cheaper than U.S. aluminum. We don't produce a lot of aluminum in this country. I can see you're chomping at the bit to say something. But
no, to read more of this.
I just want to point out,
please.
you know, the reason that we import so much aluminum is because Canada can make it much more cheaply than we can. And this effectively erases that.
Well, here, then, what do you make of this other headline that's been coming out? It's a long post, right? He's going to be declaring a national emergency, he says, on electricity. But he also said he's going to threaten to permanently shut down the Canada car industry. Can he do that, Matt?
I mean, he can, if he wants to, effectively shut down Americans buying Canadian cars with big enough tariffs. Of course, I suppose they could still produce cars for other countries, but there aren't any Canadian car makers per se, right? They're just producing, you know, Fords and Stellantis, you know, Dodge and Chrysler vehicles.
Mike McKee, we only have about 30 seconds, but weigh in on this as our economics correspondent.
Well, we had one interesting data point this morning, and that was the NFIB Small Business Survey. And in that, their uncertainty index rose to the second highest level ever, which may explain some of companies' reluctance to do a whole lot right now because they have no idea what's going to happen.
All right, you can see the dollar index there continuing to trend lower. We also have stocks falling. The S&P 500 now down 0.7%. Katie was telling you that the NASDAQ recovery was building steam.
And Ford. You take a look at the automakers
yeah, Ford
really
stock
quickly.
down 1.4%. Of course, they need aluminum and steel to build those F-150s.
I would imagine so.
They had high margins, but they're not going to be that high with 50% tariffs. By the way, we welcome now our Bloomberg TV and radio audiences. We're joined by Bloomberg Wall Street Week host David Westin and Larry Summers.
For our Bloomberg audiences worldwide, I'm David Westin, and I'm delighted to be joined by Larry Summers, former Secretary of the Treasury and now at Harvard. Larry, thank you so much for being with us today. The talk of the town are the markets. I won't press you on the markets, but tell us about the economic numbers underlying this, because there are indications of a slowing economy.
David, I think we've seen a sea change in perception in the just almost 2 months since President Trump was inaugurated. At that time, the prevailing view was very strong economy, possibly inflation, risk, United States exceptionalism relative to the rest of the world, likely to manifest itself in continued U.S. outperformance. But the combination of substantial immigration restrictions, substantial layoffs in possible prospect from the federal government, the damage to U.S. competitiveness and to U.S. production done by tariffication, and above all, a big increase in risk premiums have led to sharp reductions in spending on the part of both consumers and on the part of businesses, and even more sharp reductions in intended future spending. You saw that, for example, when Delta Airlines reported a soft first quarter and a very soft set of reservation requests going forward last night. So you take all that together, you take the fact that markets were starting at a very high level in terms of valuation, and I think you have to say that there's in the range of, I'd say still slightly below, a 50% chance of a recession starting this year. You know, I've watched economic forecasts for a long time, and one thing I've observed is when they start being revised in a direction, there tends to be momentum. And all the revisions are going one way at this point, which is towards less growth. So I think we've got a real uncertainty problem. I think it's going to be hard to fix that. And we're looking at a slowdown relative to what was forecast almost for sure, and a serious near 50% prospect of recession.
So taking you very literally about that close to 50% chance, for our audience, what numbers should they be looking at to determine what side of that 50% we end up on?
They should be looking at what the slope of the yield curve is and what people are expecting the Federal Reserve to do. The more people are looking for sharp cuts by the Fed, the more they're judging that a recession is likely. They should be looking at what's happening to stocks, and particularly stocks in traditionally cyclical industries. They should be looking at data that points a little bit over the horizon. Data on order books of businesses, data on consumer intentions to buy a car or to buy a house in the next several months as an indicator for judging what is going to happen. All those things taken together, I think, will tell a story. There's also information in what is happening to commodity prices. And I pay a lot of attention to the various compilations that come from investment analysts who are very close to firms, who are reporting which way the firms are revising their own forecasts of future revenue and future earnings. All of that are the sort of indicators of what's happening in the economy. I think at a different level, the thing to be looking at is, are we getting more policy certainty, or are we getting more policy uncertainty? Every time there's a major vacillation, every time there's a question about commitment to law and to commitment to following the law in any sphere, you're gonna be getting more uncertainty that is ultimately a prospect for chilling investment.
So President Trump has addressed this and said we're going through what he called a transition period on the way to what he called something very big here. To try to argue his side of it, is this a necessary sort of transition to rebalance the economy, get the government out of the economy to the extent that it was, and really go forward to a better future for the economy?
No. Look, David, transition period. Doesn't it sound like a lot like the word transitory? The idea of transitory inflation, when it was put forward by the Biden administration and the Fed when things weren't going well, didn't work out very well. And I don't think the idea that this is some kind of transition period is going to work out very well at all. And why do we think that it is going to help the U.S. economy to not be able to use Mexico and Canada as a production partner, given that we are competing with Asia and Europe? I don't see what that logic is. Why is scaring people about whether they're going to get their Social Security benefits, scaring people about whether the United States is going to continue to develop new medicines at the NIH? Why are those things thought likely to increase confidence? If this was going to increase confidence and people saw it, you'd expect to see surveys of consumer confidence showing an improvement in conditions, and you don't see that at all. If this was going to increase, was just a temporary dip that was going to increase the prospects of businesses, you'd see their stock market values going upwards, not downwards. I think by far the more likely thing is that we are in the shallow end and we're walking towards the deep end, and the problems are only going to increase with the passage of time. You know, this is not the first time that a country got a new leader who gave a lot of orders and imposed a lot of tariffs. That populist policy mix is a standard around the world, particularly common in Latin America. And what the studies show is that it can go either way in terms of its impacts in the short run, but it's almost always bad over the medium to long run. So I'd expect, unless there's a reversal in policy, I would expect this situation to get more serious. And every time the president uses rhetoric that conveys steadfastness on this policy course of tariffication, of economic nationalism, of greatly expanded concept of government action and vast, wide interpretation of government power, every time he recommits, pessimism increases. And so I think those explanations of downturn being temporary are actually quite counterproductive.
Larry, to play devil's advocate, I think that if somebody were here from the Trump administration, they say the transition is to a world where we have a bigger manufacturing base. We had Sean Fain from the UAW just recently say he thinks what he's doing is exactly right because we've lost so many jobs. Is there an argument that, in fact, we could be rebuilding the manufacturing base that could help the economy in the long term?
Manufacturing has trended downwards for 60 years. It has trended downwards in Germany as a share of the economy. It has even trended downwards in China as a share of the economy. There's a reason, which is that there's just lots that used to be done by people on assembly lines that can now be done by machines. And there may be blips from one year to the next, but the idea that we were going to have some kind of durable manufacturing renaissance was a chimera when Joe Biden said it, and it's an illusion when Donald Trump says it. And the much more likely thing is that the particular kinds of protection that the Trump administration is stressing are actually going to hurt manufacturing. Think, for example, of those promised aluminum and steel tariffs. 60 times as many people use businesses use aluminum and steel in their production as are in the aluminum and steel industries. So we're raising costs. This administration can't understand, or seems not to be able to understand, is that today we live in a world of supply chains. And in that world of supply chains, when you tariff things, you're increasing the price of inputs that would have gone into exports or would have gone into competition with totally imported goods from further abroad. So I think the idea that we're going to have some manufacturing renaissance of employment is misguided. And I think in terms of strategy for getting there, it would be, if you wanted to have that as an objective, your chances would be much better subsidizing their outputs than raising the price of manufacturers' inputs. So I think this is protectionist policy, which as an economist, I don't like. But entirely separate from that, it's misguided and confused protectionist policy, even if one accepted the protectionist philosophy.
Larry, one last one here. We are going into FOMC, Federal Open Market Committee meetings. We're supposed to have statement of economic projections coming on. How on earth does the Federal Reserve issue a statement of economic projections given the uncertainties?
I think they should follow the consensus, and the consensus is moving downwards. I hope they don't set them in stone too far in advance of the meeting, because I think we've got a rapidly evolving situation. And I think the Fed's in a delicate situation. On the one hand, some people no doubt will think that as the economy weakens, you should be moving more towards signaling strong interest rate cuts. On the other hand, for the Fed to send that kind of signal would be alarming to people, would have a material effect on sentiment, and I'm not sure just how much it matters. If a car is a lemon, or you're worried that a car might be a lemon, you're not going to buy it because somebody gives you a discount or cuts the loan rate. In the same way, when there's so much swirling uncertainty and the props from under your investment might be removed by some new policy coming out of some decree, you're going to wait before you invest, and the exact level of the interest rate isn't going to matter very much. So I think the Fed needs to express its concerns about the economy in the context of the current moment. It wouldn't be the first time federal central banks have expressed concern about rigidities. They've expressed concern about budget deficits before. I think they need to highlight just the very substantial toll that uncertainty is taking on the economy, and note that they've only got very limited capacity to respond to that uncertainty. And I think they need to remind us all of something. They need to remind us that the test of policy is economic performance. Sometimes this administration seems to be saying that as long as the 10-year interest rate is coming down, things are going well. Well, the 10-year interest rate fell the fastest during the financial crisis. It fell the fastest after as the 2001 recession was starting. So it fell the fastest at the beginning of COVID. So the idea that somehow trying to get the 10-year rate down fast is some measure of how well you're doing policy, which is another thing we've heard from the administration, I think isn't right. And I hope as he answers questions and talks about things, Chairman Powell can emphasize the centrality of simply trying to have stable economic performance.
Larry, thank you so much for joining us today. It was really important to hear from you. That's Larry Summers, former Secretary of the Treasury, now a special contributor for Wall Street Week. Now, back to you.
And our thanks to former U.S. Treasury Secretary Larry Summers and, of course, Bloomberg Wall Street Week host David Westin. Fantastic to get his reaction to what we learned at 10:03 in a Truth Social post from President Donald Trump, saying that he's increasing Canada's steel and aluminum tariffs to 50%. That goes into effect tomorrow, according to the Truth Social post. He also threatened to permanently shut down the Canadian car industry and that he will declare a national emergency on electricity. You take a look at the market reaction right now. The S&P 500 down 0.5%. The NASDAQ 100, we talked about that gain that was building, erased right now, down 0.1%. The bond market pretty quiet, which seems a bit of an anomaly here. But let's take a look under the hood, because this is where it gets really interesting. U.S. Steel, Century Aluminum, shares rising, as you can see right now. On the downside, as you might expect in Matt Miller, you have the likes of Ford, General Motors taking a dive right now.
Yeah, I also see some big energy gainers, which obviously with a national emergency on electricity and these big tariffs going into place against Canadian energy, you can imagine, but it's across the board for solar. So you've got renewables there, EQT, which is natural gas, NRG, VST, Vistra, which was the big gainer last year. So massive gains. Here you see the intraday moves on the energy sector. Let's get right now to the biggest bull on Wall Street to react to this. John Stoltzfus is here of Oppenheimer. He has, as we said, a 7,100 year-end price target for the S&P. And John, I imagine, you may take the timing of that out a little, considering the volatility that we're getting from policy affecting the markets. But are you still that bullish?
I certainly am still very bullish about where we are right now, okay? That looking forward, looking ahead of where we are. Our goal is beyond. But in terms of 7,100, you've got to remember when we put it was in December of last year. The market was clicking up almost every day. The market was feeling that we had a business-friendly administration coming to the fore in the new year. And when we looked at it, we thought that 7,100 was quite achievable.
But John, is this a business-friendly administration?
Well, I think so far it would seem to be less so than was anticipated, okay? But one has to realize that there's a lot of pushback likely to come from business as well as from the consumers. And one thing that the current administration it is sensitive to feedback, even though the style is very much the art of the deal. It's like, here goes, folks. But we have every day is one day closer to the midterm election. And I think the midterm election and the outcome of how that will affect the Senate and the House are very important on the agenda when it comes to the White House. And one of the reasons all this is happening so fast and so dramatically, I think, is likely because there's less time every day to that midterm
election. I, too, am watching those midterms very closely. It feels like it's coming right around the corner, the way things are going. You know, you look at the trades that investors are piling into on the heels of every Truth Social post. I'm looking, for example, at U.S. Steel, now up 7% on the year, 3% on the day. You had a stretch of declines into growth fears and then obviously a little bit of a turnaround today. Do you think some of the trades that are being put on the heels of the tariff rhetoric might be misplaced if you're the kind of person that thinks he's just posturing?
Well, I must say so that I think what happens is when you get to a point like this in the markets, it's very delineated as to you have to figure, am I a trader or am I an intermediate to longer term investor? And the traders will play anything that adds bips to the bucket that they're collecting to make up the vanity license plate they're going to put at on their new car at the end of the year.
Yeah.
Okay? And so as a result of that, you have to take all that in context of the history of the markets and the way it works. It's a combination of math and emotion mixed at times with political change. It's dramatic. I mean, I wasn't an apologist for the Biden administration, nor am I for the Trump administration. I just have to call it the way I see it as a business person. And when I look at where we are right now, you've got an administration that is dealing with something that no administration has even attempted to deal with in decades. After World War II, the U.S. rebuilt Germany. It rebuilt Japan. It had destroyed the Nazi empire. It had destroyed Imperial Japan. It rebuilt them. It reconstituted the world. Now, of course, there was self-interest in that because we had a lot of factories that could sell a lot of things that would help rebuild the world. And then we moved to a point where we decided that we were going to move most of our production outside of the U.S. And I think what happens right now is the administration recognizes that related to tariffs, we're the biggest buyer in size. It's hard to replace us in a world where we're the biggest consumer. The rest of the world has overcapacity in production. If you look at China, if you look at Europe, how can they get it's in this with higher tariffs? It makes it harder to find somebody to replace us. And I think ultimately brings people to the negotiation table, and we'll get something that will be considerably ameliorated rather than something as drastic.
I mean, I think a lot of people would agree with the end goal, but it's the means that are questionable. On that note, there's a guy in Scarsdale with the license plate GLBLMCRO, so Global Macro, on the back of his Cayenne. And I always think, I wonder what hedge fund that guy's trading for.
And that's not your car.
No, I'm not. There's a guy with vanity plates midtown that says Velocity. No, I'm sorry, volatility. It's misspelled because you can only have 7 letters, and so you have to miss one.
Velocity is Tom Keene's license plate. That's what he has on his match.
But this would be volatility. And you know, there used to be one Ginnie Mae, and there used to be a physician who had a Bentley at least 30, 40 years ago, and that Bentley said HMO1. How's that?
I like that. I like that.
Mine just says 60-40 because I like diversification. But John, we only have about a minute left with you. I want to go back to what we were talking about. That you know, this was expected to be a very business-friendly administration. Maybe it is, but the sequencing has been a bit unpalatable for these markets. How are you updating your playbook? I assume that you had some playbook from the first Trump administration, and it feels like maybe the playbook is different in the second.
You know, our playbook is one of cyclicals over defensives. We think it's a little bit late to get defensive. You know, when the market turned down in 22, some people were saying, well, it's time to get defensive. We thought it was a little late. And sure enough, in the fourth quarter of 22, that's when the market started rallying into 23 and into 24. The calls for recession have been wrong now for years, okay? So we have to take that with a grain of salt. We continue to like favorite sectors remain technology, communication services, consumer discretionary, industrials, and financials. We think we're leading towards a position, moving towards a position of further growth in the U.S. economic. We do think I'm not disagreeing with Bostic of the Fed, of the Atlanta Fed, in terms of thinking we might get a negative print on the first quarter GDP. But you know, that can happen, but you have to take a look, what's the ultimate goal here, and what are the pressures that are put on politicians on both sides of the aisle to cooperate, to get some kind of a deal, whether it's with the budget, whether it's with tariffs with other countries. The pressure is on because the constituencies have become accustomed to things getting better than rather worse in many ways, even as there remains a lot of tension in the system.
John, great having you here. Thanks so much for joining us. Fantastic to get that intel from John Stoltzfus of Oppenheimer Management.
All right, let's quickly get a check on these markets here. We know that this is a very fluid situation when it comes to the global trade picture and also these markets. But at least for right now, you can see the S&P 500 pretty dang close to session lows, down about 0.7%. The big tech index, your NASDAQ 100, down about 0.5%. And that follows that 3.8% sell-off that we saw yesterday alone. Then you take a look at the bond market, not exactly behaving as the haven it has been. Yields pretty much unchanged. You can see, though, under the hood is where things really get interesting as we await those steel and aluminum tariffs, as Trump says, going into effect tomorrow. You can see U.S. Steel, Century Aluminum higher right now On the downside, the other part of that pair trade, if you will, you have the automakers really in the hurt locker right now, Sonali.
Yeah, a hurt locker for the brunt of the year at this point. We're going to turn to tech also in the hurt locker. The NASDAQ 100 posted its worst day yesterday since 2022, wiping out more than $1 trillion in value, and many of them are still in pain. Bloomberg Technology co-host Caroline Hyde is in Las Vegas at the inaugural HumanX conference. The event is aiming to highlight how AI can be useful to organizations globally, and I'm sure on the ground there today they're going to be talking about where the money is coming from as well, because if you look at the Magnificent Seven at the moment, Caroline, you have Apple leading the losses. Explain what's going on under the surface.
When they stop taking their group picture, they'll be back talking about the implications of AI and indeed what's happening with Apple. Look, Apple is under pressure once again, and in large part this is because of the delay to the infusion of artificial intelligence within Siri. And this, many are feeling in the analyst community, is going to delay that upgrade cycle for the next iteration of iPhones. This is as we got that scoop from Mark Gurman saying Apple is busy looking at a complete overhaul of its operating system so that ultimately it's a more seamless event when you move from your iPhone to your iPad to your Mac. This is going to be the biggest overhaul in operating system since 2013 for the iPhone, since 2020 for the Mac. But it's not enough to spur that risk-taking back in Apple's name. We got some negative news around the DOJ investigation into Google and its potential monopoly status. They're worrying about, of course, selling off Chrome for Google, but also about the payments Google makes to Apple. So that's another downdraft on this stock. But as you mentioned, this is such a painful trade right now. We are selling our previous winners. We are selling the Magnificent Seven because we are worried about whether AI can be the silver lining in what is economic dark clouds right now. People questioning that, particularly with Oracle's numbers that didn't live up to expectations. That demand for data and for infrastructure just not living up to the anticipation for this fiscal quarter and the one that we're currently in. Certainly in the next year and the year ahead, they do point to 15%, 20% revenue growth, but not enough to relieve that anxiety that maybe the demand for data centers, maybe the demand for artificial intelligence writ large is enough to vindicate some of these valuations in the space.
I got to ask about Apple, Caroline, specifically. Yesterday, the stock was the biggest drag on the S&P 500 as well as the NASDAQ 100. This is a stock that's been literally decimated year to date. It's down more than 11%. Is this revamp of, the operating system like an ace up their sleeve to sell more iPhones and iPads and MacBooks, or is this something they've had planned for a long time? How do you see it?
I see it as what generally comes in June at the Worldwide Developers Conference, that yes, we do tend to get an update to the operating system and ultimately trying to get developers to get excited about what they can build for Apple in the ecosystem. There are more than 2 billion Apple products out there, and they want to make sure that we've got a reason to upgrade. And is a new operating system that reason? It had all been about Apple Intelligence, but that Apple Intelligence isn't serving us much right now. Sure, I might get a Genmoji. Sure, I might get an update to my email and a prompt to show me how it's amalgamating the most priorities that I've got on the day. But if they're not going to upgrade Siri in the near term, and that was an amazing bit of reporting coming from Mark Gurman, and they've since been qualified, if that's not going to happen, why am I going to go and get a latest Apple? And I think that's ultimately they're trying to maybe drip feed this operating system upgrade for the reason that we're going to get a re-injection of demand for them. But right now, it's about consumer concerns over in China and here in the United States.
You can't just say Genmoji without explaining what in the hell that is.
Well, I'll show you offline.
Do people know?
It's an emoji that you can generate, I assume.
I didn't know if it was like a Gen X thing or
we'll discuss offline.
Gen Z.
I will say it'll
Gen
take
X.
a lot of Genmojis for me to actually upgrade my phone. Caroline, great reporting. That is Caroline Hyde. And in the next hour, she'll be joined by Alfred Lin of Sequoia Partners, as well as Raider CEO May Habib. Meanwhile, stay in the AI world right now and talk about a deal, because ServiceNow has reached a deal to buy AI firm Moveworks for nearly $3 billion. This deal will integrate Moveworks' AI assistants with ServiceNow's applications to offer an AI-powered self-service tool for customers. For more on this, I'm pleased to say we're now joined by Bhavin Shah. He is the CEO of Moveworks. Great to have you with us. The reaction to this deal, the question that I keep coming back to is, why sell now? It feels like AI, obviously, even despite what we're seeing in the tech industry, is the hottest spot to be right now. So why sell at this point versus hold out for an IPO, for example?
Well, thank you for having me. And, look, there's no question that the future of AI centers on the advancement of agents that'll help employees automate and search and take actions across their business systems. And you're right, we're only at the very beginning of this transformation. But Moveworks has been building this for quite some time. And we are thrilled to be a part of the ServiceNow team so that we can together really simplify and accelerate the scope and scale at which we can deliver this to the entire world.
You have a lot of big ticket clients, Marriott, Unilever, Honeywell, Broadcom, CVS. We normally have not been asking this of companies in the AI space, but given the B2B focus in so many ways, how concerned are you about a slowdown more broadly in the economy that could stunt the ability for businesses to spend money on some of their AI initiatives?
Well, I think for us, and what we saw this play out during the inflationary periods of the interest rates after COVID, that businesses need automation. They need deflationary tools like AI. And agentic AI is really giving us a lot of leverage and opportunity for businesses who can't spend as much to operate their organizations. AI can come in and really help with providing that leverage. And so I think that whether the cycle is moving up or down, we see ourselves as an essential component for enterprises going forward. And that's what you see in the logos and the names of the folks that have been working with us over the last several years, if not longer, to really deliver a sustained model in which they can continue to operate their businesses more efficiently while giving their employees a very intuitive, simple interface to interface with all sorts of different underlying business systems.
I wonder what you think of, I've been following Bill McDermott's career since he was running SAP, and now he's been running ServiceNow for about 5 years. He's basically quadrupled the value of that company. What does he offer you as a leader, and what do you see him doing with AI?
Well, I think they've built an incredible platform, and they have now really understood the nature of work across every industry. We have a large overlap of over 250 customers that we serve with ServiceNow. And so we've had an inside look into what that platform can do, what they have delivered for our customers. And our customers love both of our products. And so as we've seen them grow, and to your point, Bill has done a phenomenal job for the business over the last 5 years, we're really excited about being able to leverage that sort of platform more so, as well as really help provide a new interface for employees across these large enterprises as a complementary component to what they've already provided.
Well, take us in a little bit to this deal then. How long have you been in talks with ServiceNow, and how did this deal finally come together?
I think we have been integration partners for over 8 years now. So we have been long-standing partners on that front. As I mentioned, lots of companies use both of our products, and we've been innovating in different areas. The Moveworks team has been really focused on an AI-first agentic layer that employees can use to have this intuitive interface into lots of business systems. We have over 100 integrations, including ServiceNow. And so they have, of course, been building a greater and greater presence across different verticals and different areas throughout the enterprise. And that has been something that we've watched, and we've continued to integrate. Now, when you ask about the deal, we've known them. They've been a partner of ours, and I think just a few months ago, Bill and I had a chance to sit down and really talk about the agentic future and how important that is to both of our visions. And look, we have vision lock with one another. And so very quickly, we decided this was going to be a great path forward to really provide something that the world really wants. And they want it now, and they want it fast.
Right.
And I think together, we're able to deliver that.
Vision lock, that's a good place to leave it. Congratulations on getting this deal done in a very volatile market. That is Bhavin Shah of Moveworks. Meanwhile, let's get back to these markets. We are tracking the fallout from that Truth Social post. Donald Trump saying that he's increasing Canada's steel and aluminum tariffs to 50%. The president saying that those go into effect tomorrow. And you can see the S&P 500 now down 1% at session lows. It's at its lowest levels since early September. You take a look at the NASDAQ 100, similar story playing out, down about 0.8%. And finally, a bid materializing in the bond market. People rushing for safety right now, sending that 2-year Treasury yield down 2 basis points back below 420. We'll continue to track the fallout and bring you details on those tariffs next. This is Bloomberg.
Now, the big news of the hour, President Trump says he's doubling tariffs on Canadian steel and aluminum effective tomorrow morning. The move doubles a 25% metal tariff that's set to take effect just after midnight. Let's get some insight now from Richard Burke. He's the senior analyst of metals at Bloomberg Intelligence. We are also joined by Joe Doe, who covers metals and mining at Bloomberg News. This is a dramatic increase. Can you talk us through here just how many things will be affected? You were talking about electricity a little bit in the break, but there is a daisy chain to consider here, isn't there?
Yes, I mean, aluminum, the U.S. relies on aluminum imports because the number one cost to produce aluminum is electricity. U.S. electricity cost isn't competitive with the rest of the world. So therefore, and Canada has a better cost basis, mainly because hydroelectric power up in Canada. So the cost to a customer to get aluminum into the U.S. is the price of aluminum that we see on the LME plus a delivery premium called the Midwest Premium. So you've seen in the last few weeks when the talk from tariffs had started, the Midwest Premium previously had reflected a 10% tariff. Then it moved and it's reflected a 25% premium over the last few days or over the last month or so. And now we'll see, if you watch that, we'll see how will it go up to 50%. I kind of doubt it will go that high, but I think it will go beyond 25%.
Right. Well, I'm looking at the Midwest Premium. My producer Joe in the control room can pull that up year to date. It's gone from like 20 cents to 40 cents so far, but that was only at the end of business yesterday. Right. Now we're looking at a 50% tariff. I think a lot of people were expecting 25, so that could change dramatically at the end of business today. Joe Doe, if I'm Mary Barra, or if I'm Jim Farley right now, sitting in Detroit, knowing that I have to buy aluminum to build my F-150s, how's that going to look?
I think this is a shock. I am already making calls around the market trying to figure out what people are thinking. I think this one's coming as a bit of a shock. It's unclear if the President of the United States had given a heads up to either of the industries or other industries that he might be considering doubling these. Listen, the Ford CEO said at the middle of last month that the aluminum tariffs would blow a hole into the industry. I think that was also with the idea that it would stack with the Canada-Mexico tariffs that actually have not come into place. But now you've effectively...
Well, they will on April 2nd, right? Because Donald Trump has been clear that he's given them a reprieve for 1 month.
Let's ignore that for a second. They were assuming, okay, if you get a stack, right, tariff stack, you had 25% on aluminum, and you were going to get 25% on Canada, which is the biggest producer that the U.S. consumes from. More than half of what we consume in the U.S. is produced in Canada. So then they were saying, wait a minute, 50%, that's way too much. Well, guess what? Sure, you put a delay on that till April whatever. But now you're saying, you know what, we're just going to do 50%. Now you've just actually created the same problem that you had before. And that's even before we get to the fact that, oh my gosh, these Canada-Mexico tariffs are supposed to come into place in April, and then that would stack on top of that. We haven't even gotten to steel. Steel's the actual tonnage. That's a much bigger market.
Let's talk a little bit about steel. And Rich, I'm curious to get your perspective here because you see the reaction in the stocks of U.S. Steel, for example, Nucor, some of the equities that fall under your coverage. What does this mean for those companies, and what was their position heading into this period?
Well, what it means is that obviously the price of steel has greatly increased, and it should increase a little bit more. But it's also what's going to do is start to attract imports also, because people are going to say, well, even if the price of Canada's steel is up 50%, but the price of the rest of the world is only up 25%, so I can afford to take a 25% tariff on their price and bring it in.
Right.
So if you look at the U.S. imports about 20% of their needs a year. We've looked at probably a third of that is actually steel that the U.S. producers don't want to make or can't make. So that still has to be imported. And the rest, the other one, is opportunities for these other companies to step in and fill the void with those, make those grades of steel that they hadn't in the past.
You know, to that end, we've seen U.S. steel take a little bit of a jump on today's news, but it had been tumbling into today. It's still up on the year. Growth concerns on one side, then the tariff pressure on the other. How do you net out those concerns, Joe?
I mean, demand's the bottom line. If nobody has confidence in the economy, because that's what we're talking about here. We're talking about GDP. If nobody has confidence in the economy, because tariffs are coming on the win, why would you buy steel? So yeah, maybe you get a short-term bump in price if you're the mill. But looking out, inventories are the highest we've seen in years. Consumers are the bottom line here. And if they're not buying steel, it doesn't matter that you're saying, well, guess what? There's no foreign imports coming. Because they're not buying the domestic stuff either. So I think that's really what we're going to have to watch today. There's a lot of concern in the market, I'm sure.
And it's worth pointing out, I mean, we're coming off a year where U.S. steel was down 30%. I know it had some idiosyncratic issues, but it's been a pretty ugly picture.
Well, but even away from the stock price of U.S. Steel and Nucor, it seems like, or I'm sure he would tell you, what President Trump wants to do is bring production jobs back to the U.S., especially steel jobs. So are you saying you don't think that Nucor and U.S. Steel are going to be ramping up their production of aluminum and hiring a ton of people? Like, is Allentown going to be
Well, they're not going to be
bustling?
hiring a ton of people. They could ramp up production. Right. But the great thing about these EAFs is they don't require a lot of people to operate. And that was never the point in the first place. Donald Trump made clear in 2018 that it was about capacity utilization to improve the profits of the steelmakers. It wasn't about hiring more people.
All right.
If you look at utilization, the industry last week was at 75%. So it does have some spare capacity to ramp up. Aluminum's a different story. The U.S., our electricity costs aren't competitive, so we're not going to be able to add production of aluminum in the short term. And no producer is going to do it unless they can get a 20 or 30-year power contract that locks in the price of the power.
But steel, will they add jobs in steel production?
Well, I don't know if they'll add jobs, but I think they'll take that 75% utilization they're running at and ramp it back up to, the mid-80s.
Yeah.
All right, guys, we got to leave it there. Stay close. Great to have you two run to set after we got this breaking news. Really appreciate your expertise. Our thanks to Richard Bork of Bloomberg Intelligence and Joe Doe of Bloomberg News. Let's get a check on these markets, tracking the reaction there. The S&P 500 now down about 0.9%. It was down 1% a little bit earlier. Big tech, the Nasdaq 100 down about 0.6% as well on very hefty trading volume right now. The trading volume about 28% above its 20-day average. That certainly tells you something. And the bond market, again, not really behaving as that diversifier, as that haven asset right now. The 10-year Treasury yield camped out at 4.20. Much more coming up. This is Bloomberg.